and we'll get started here in just a minute. All right, so let's get to it. There are a whole bunch of laws for 2021. We've had a big change in Prop 13. We've got a lot of our clients are aging parents and they want to preserve Prop 13 for their kids. We'll talk a lot about that, which is Prop 19, right, passing. And then we're going to talk about Biden's tax proposal, because that's really kind of top of mind for everyone. What's going to happen this year, 2021? What's going to happen next year, 2022? This is what we're going to talk about. So this is a disclaimer. I'm a lawyer. I'm talking. This is not legal advice. This is not tax advice. This is information. Okay. So we're going to give you the opportunity and instructions on how to reach out to us if you'd like some help with our firm. But really, I mean this with all sincerity, this is not legal advice. Okay. So don't run out and do a bunch of planning based on this. This is just for your edification and your learning. So I'm Jim Cunningham. I'm an attorney. I'm owner of Cunningham Legal, 25 years experience. We have offices in the Capital Region, Bay Area, and Southern California. I'm a certified specialist in estate planning, trust, and probate law, and I've got some other certifications there, a real estate broker, securities and insurance licensed. So I've got a pretty broad background in a lot of planning strategies that higher net worth families use. And you may not think you're higher net worth, but certainly the government does, because your assets, you can think of them as not being totally yours, but everything you own is held in a joint account with Uncle Sam, and Uncle Sam's going to get a chunk of that certainly every year and when you pass away. So these are the lawyers in our firm. That's me and the other lawyers. All we are doing here is focusing on estate planning, tax planning, trust matters, real property taxation. We're not doing car accidents or other type of cases. Please subscribe to our YouTube page. If you're watching this recording, we are recording this. This recording will be available. Please go ahead and subscribe to our YouTube page, especially for this year, 2021. This is a huge year for taxes. Lots of changes on the horizon. I mean, I think back to a year ago. Right now we're in January of 2021. January of 2020 was a totally different world. I think we can all agree with that. So please subscribe to our YouTube page and stay abreast of these really current and important topics. So on a real high level, if you're watching this video, you're like a lot of our clients, and they want to know, how do you pay the least taxes possible? Because people, frankly, most rational people do not want to pay more taxes than they're legally required to pay. And so the purpose of our firm is we're here to help you craft a plan, give you some options, make recommendations that reduce your overall tax bill, ultimately leading for more wealth for yourself, your family, and your loved ones. As they say, it's not what you earn, it's what you keep. So here are the two big things that are happening in 2021. The two big things that are happening are a result of the 2020 elections. So two things happen. In California, Prop 19 passed. We're going to talk about Prop 19. That takes away your ability to leave your Prop 13 taxes to your children. And the other big headline news, of course, is that we have a new president, January 20 of 2021. It's a new term. I'm not making it. There's a lot of stuff going on in the world right now. I'm not making a political statement. I'm a realist. That's the direction it's headed. And it looks like Joe Biden will be president effective January 20th of 2021. That has a lot of changes, right? So we're going to go through his tax plan, the high points of his tax plan, so that you can start thinking about this. But I do want to talk about Prop 13 and Prop 19. So we have by the way, if you have a question, put it in the Q&A. If you're watching a recording, obviously, you're not going to be answering, we're not going to be able to answer a question, but this is being recorded live. We have lots of people on the webinar, but go ahead and you can put your question in the Q&A. You can also put it in the chat, but it's a little bit easier if you put it in the Q&A. We do have one question. What happens if the inheriting child moves away from the principal residence property? So we'll talk about that. But let's talk about Prop 19. So what happened? What happened in November of 2020? Well, Prop 19 passed. Prop 15 did not pass, and Prop 15 was the reassessment of commercial and industrial property. For those of you who own commercial and industrial properties on net leases, meaning you are the property owner and you lease to a tenant who pays the taxes, the maintenance, the insurance, not a big deal necessarily, right? It's going to be, that burden's going to be passed to the business owner. If you operate commercial or industrial properties on a gross lease basis, so if you have a strip center and maybe you've got, you know, a liquor store and a tattoo parlor in there, maybe a C-class rent, they may be paying gross rent, so they might be paying $2 a square foot, and you're going to be paying all the costs as the landlord. You really need to pay attention to this, because this is on, and I've been saying this for years, guys. I've been saying this for years. The state of California, the legislature, I live in Sacramento, not that far from the Capitol. I know people who work in government. Nobody likes Prop 13. They all want to get rid of it, okay? And don't kid yourself. This really constrains the state of California on raising revenue and spending. And as you know, they like to raise a lot of revenue and they like to spend it. But nobody in government likes Prop 13. They are doing anything they can to erode it and take that away from taxpayers. And I'm not throwing shade on state workers or the state. It's just really hard for California to raise revenue when they're constrained by Prop 13. I think Prop 15 will likely be coming back, or some iteration of it will likely be coming back. So understanding the property tax issues involved when buying out a sibling, when taking any distribution, you really need to understand Prop 13 and Prop 58. So let's talk about Prop 13. So Prop 13, way back in the 70s, property taxes kept going up and up and up. People didn't have money to pay the tax. And so they passed this ballot initiative in 1978. What this did is, if you bought property up until 1978, they rolled your tax rate back to the 1975 rates, and then taxes only increased 2% a year. Very important to understand, the average percentage tax rate when Prop 13 was passed was about 2.67% in California. It dropped the tax rate down to 1%. So not only did it lock in low taxes, it locked it in at a relatively low rate of 1%. So let's take this example of a home that is in Cupertino. This is actually taken from the multiple listing service. It's a couple of months old now. This home is listed for $2 million. Now, if you live in Cupertino, you understand why it's $2 million. For those of you who aren't sure where Cupertino is, it's Apple's headquarters is in Cupertino. It is the Bay Area. Real estate is very expensive, and that's just how it is. But back in the 70s, mom and dad buy the home for $50,000. Now the property's worth $2 million. The property is assessed at $120,000, and the reason is that $50,000 tax assessment, the value upon which the assessor bases the 1% rate, okay? That property is valued, that property was purchased for $50,000, and the taxes have gone up a maximum of 2% a year. And that's how you go from the 1970s to the 2020s, and your assessed value is only $120,000 because it's only gone up 2% a year. But of course, the market value of the property's gone up over 8% a year. So the current property tax structure in the state of California is, whenever there is a change in ownership, and that is defined in the Revenue and Taxation Code. Whenever there's a change in ownership, I sell a property to Andy, right? I sell that property. That's a change in ownership. I move out, Andy picks up the mortgage, and Andy moves in, and that's his house. That's what we're talking about. Here's a change in ownership. Property is reassessed at its fair market value. Okay, so not its sales price, not necessarily what you put on the gift tax return, but the assessor's office makes their own independent judgment, and they impose a 1% tax plus some added sweeteners that vary by locality. But something to bear in mind is, a sale is a transfer, a gift is a transfer, but what many people don't think about is that death is a transfer. So what that means is, when mom and dad die, the date that mom and dad die, if dad dies and then a year later mom dies, the date of mom's death is the date that transfers from parent to child. So something to bear in mind though, even if you didn't buy your property in the 70s, let's say you bought your property in the 80s or the 90s, you are still protected by Prop 13. If you buy a home in 2021, you're still protected by Prop 13 because your taxes are capped at 1% plus that 1% tax assessment rate, right? So if you buy a property for $1 million, it's assessed at $1 million, your taxes are $10,000 plus some extra local taxes. That $10,000 tax bill can only go up by 2% a year. It doesn't matter if your house doubles in 5 years. Your property tax bill is only going to go up a little bit every year. So everyone is protected by Prop 13. And as a general rule, people who have owned property for longer in California have a more favorable version of Prop 13, frankly, because they bought the property a long time ago. So in the 1980s, what happened is Prop 58 came around, and the Prop 58 says, hey, this Prop 13, this is a really good idea. But when the parents die, the property gets reassessed. Wouldn't it be really cool if the kids could live in mom and dad's house in Cupertino and keep their taxes? Well, in 1986, California voters said, yeah, we think that's a great idea. So it lets the kids keep the parents' Prop 13 taxes. And there is an unlimited parent-to-child reassessment exclusion when it comes to the home. And what we're talking about here is the home. And this home could be assessed at $1 million and be worth 20 million, right? And there are homes in California that are worth 20 million that might have an assessed value of $1 million. It might have an assessed value of 2 million. That assessed value transfers to the children. And that's the parent-to-child reassessment exclusion. And that is Prop 13 working together with Prop 58. And remember that change in ownership includes death. So in addition to the home, I did mention that this was the case of the home. A parent can transfer to children. So a parent, and if you're married, there's two parents, right? Or if the parents are both living, right? So it's $2 million per couple. So it's 1 million per person, 2 million per couple. And so the parents can leave $1 million each in assessed value on properties other than the home. And these are commercial, industrial, and if mom and dad are divorced and they remarry, can you game the system? There's all sorts of wiggle room, right, in the property tax rules. And so you really do need to hire an expert. This is an area not for novices. This is absolutely an area for experts. And I will tell you that this area, property tax, falls between the cracks between the professionals that handle property tax matters and the trust and estate attorneys. It's kind of in the cracks. And when you get crossover with trusts and LLCs and things like that, very few people understand both worlds. So this is something that's a rather esoteric area. So let me go through some of these questions. Kitty asks, can I transfer the properties to the children in a B trust? The spouse died. Kitty, you should contact us. It depends on what the trust says, but generally, there are a lot of issues there. And what that means, a B trust is mom and dad have an AB trust. Dad dies, mom's half goes to the A trust. Dad's half goes to the B trust. Mom receives income and principal from the B trust. I will tell you, Kitty, what we are doing in those situations is we are selling the property to the children in exchange for a note. Okay. And we're working on a couple of cases like that. The benefit is that the property is transferred to the children now, because if you wait until the surviving spouse passes away, that parent-to-child transfer, if that happens after February 15th, February 16th and later, the property will be reassessed. So it's very important that you get immediate attention on that. And so we'll give you an instruction on how to reach out to our firm, but I would highly encourage you to reach out to us and book a time to meet. Marshall asks, approximately how long will an only child inheriting the parents' principal residence need to live in the house, making it their primary residence, before selling and carrying parents' Prop 13 to another California property? I don't know. The assessors don't know. I've been going to a lot of continuing education with assessors, and they say, we're waiting for the legislature to pass laws to tell us what the rules are. That's where we're at. If you're watching a recording on this, and it's 2022 or something, the rules probably will already have been written. But right now in January of 2021, we just don't know. Michelle asks, by placing the primary residence in an irrevocable trust, how does this enable the family to retain the Prop 13 tax basis? So Michelle, what we're doing in our firm is we're doing Prop 13 trusts. And what that means is it's a gifting trust where the property is transferred, the parents transfer the property to an irrevocable trust. Now, sometimes the parents can stay on as trustee. Sometimes it's not a good idea. It depends on a lot of factors, primarily having to do with death taxes. And that's done on an individual basis. But to answer your question, the assessor disregards trusts. Okay. So the assessor looks through the trust to see who the beneficiary is. The assessor does not disregard entities, which are like LLCs or corporations, but for our purposes here, an LLC. So what we do is the parents make a gift of the property in a pretty standard gifting trust, but you have to be mindful of the powers that the parent who's the grantor retains. Some of these very typical normal trusts that are used for higher net worth people can have catastrophic results for property tax reassessment. So it's very important that you find yourself a competent lawyer. And I will tell you, there are very few lawyers right now who understand this. And our firm, I would highly encourage you to reach out to us right away. We're frankly running out of capacity to handle these matters. So Anonymous asks, we gifted our home to our son prior to 2/15/21 to preserve the property tax for the son. The son plans to rent back to us and gain rental tax benefits. Son plans to gift parents the amount of the market rent. Will son be able to enjoy rental tax benefits? Any downside? So Anonymous, there are two issues here. One is if you do not pay rent, if you give your property to your kid and you don't pay rent under Internal Revenue Code 2036 1A, that property comes back into your estate if you're living there when you die or you move out within 3 years of your death. That property comes back into your estate and is taxable, is included in your gross estate for federal estate tax purposes, which for a lot of people isn't a bad thing because you get an adjusted cost basis. But for some people who don't want that coming back into their estate, and you're going to see if your assets are over $2 million with Biden as president, you're going to want to rethink not paying rent in that case, because we're predicting a massive increase in taxes, and that's probably why most of you are here for this Prop 19 and to look at Biden's tax proposals. But here's the other issue with that. If you do pay rent, it's taxable to your son, and he could get those benefits. And what you described sounds to me like you would be paying him rent. It would be income to him. Now, he's not going to probably have much depreciation, I'm suspecting, because you might have a low basis in your house, a low cost basis in your house. So I would recommend you give us a call. We can set up a time to talk and go through that with you. Lisa asks, my family lives in my mom's house that has Prop 13 taxes. Should my mom gift us the house now in order to avoid the house being reassessed? Do the taxes go up on February 16th if you're living in the house, or only if you rent out the house? Okay, Lisa, I'm really glad you asked this question. Here's the deal. Prop 19 helps current owners of California real estate. Let me say that again. Prop 19 is a net benefit for everyone who owns property in California, okay? It's a benefit because there's a lot of good stuff in Prop 19 that we're going to talk about. But understand, if the parents don't do anything before February 16th, there's no change in ownership until the parents die, or they give it away, or they sell it. So this is not benefiting the parents. This is benefiting the children when the children inherit the property. So that's really important. I'm really glad you asked that question. Kathleen asks, my mother passed away in 2017 and father passed away in last January 2020. I'm sorry to hear that. The house they left my brother and myself is valued at approximately $600,000. They had the trust set up to pass it to us. Does this change affect us since they both passed before Prop 19 passed? It might, Kathleen. I don't know if you want to take the house, or the brother wants to take the house, or if you want to split it 50-50. We do have another video on how to buy out a sibling. That buying out of the sibling very well might need to happen before February 16th. So again, I would highly recommend you reach out to us and give us a call. Carol says, we were not able to take Prop 13 advantage from Santa Clara County to Nevada County in 1989. How come it was still good until last year? Yeah, Carol, we're going to be talking about the portability of Prop 19. Anonymous asks, son is currently renting one of the parents' homes, son to inherit the rental home. What will I need to do to enable son to take advantage of our current property tax as he intends to continue to live in our rental home after our death? So the son's in one of the properties that you own, and he's renting it from you, and you're going to leave that to him. What we're doing for a lot of clients in your situation is we are either transferring the home to the child before February 16th, either outright. So here's a deed, son. The problem with an outright gift is it does not protect from divorce and creditors, and that's an issue. If it's done through the medium of a trust, we can potentially pull some levers so that the property transfers to the son, but it's included in the parent's estate for federal estate tax purposes, so the son gets an adjusted cost basis. The reason that's important is the son may want to sell that home once the son reaches 55 and port or transfer the Prop 13 tax base. And so a basis may be an issue. If the property's never going to get sold, you don't pay capital gains tax until you sell property. Again, this is the analysis we go through, and the counseling part, really, there's a lot of legal counseling we've been doing in the last couple of months with all the Prop 19 inquiries. This is where we kind of go over your individual situation and let you know, okay, these are your options and what our recommendations are. Anil asks, how can we combine the $1 million exclusion of assessed value specifically if there is only one property? Anil, if you're married, each spouse can give $1 million in assessed value in addition to the home. So it would be each spouse gifting a half, let's say, right? So versus one spouse gifting everything. Okay, so that's something that would need to be addressed. With respect to the $1 million each that parents can leave in assessed value, what if my father died 15 years ago? Would the $2 million apply for both? If your father died and there is a B trust set up, an irrevocable trust, and your mother has an unexercised limited power of appointment or no power of appointment, then Sandra, you might want to think about getting that property out of the B trust before February 16th. Meet with a lawyer. You can give us a call if we're out of space, basically, we can certainly send you to somebody else. But on this one, if your dad left it to your mom outright, like they were joint tenants on the deed, or it's a trust that says everything goes to my spouse and there's no B trust, a bypass trust, exemption trust, credit shelter trust, whatever they're called, then your mom only has $1 million exemption. Okay. So that's something where you're going to want to, and again, this is not legal advice. I'm trying to answer this for general edification, but it is possible that you lost that ability to leave an extra $1 million if mom inherited everything in her own name and not carved out in a separate trust. Pat asks, is this what happens under Prop 19 currently? No, what we're talking about here is Prop 9. We'll be talking about what happens in Prop 19 later. How does this affect our second home currently in our trust? Your second home, when you die, is reassessed if you die after February 16, 2019. And we'll talk about what constitutes a residence. Gail asks, with the new tax laws, is there any benefit of retaining an ABC trust? Yes, potentially. We might be going back to those. Alan asks, if the rental property is titled to father, mother, and child as joint tenants and father dies, how will reassessed value be calculated? Alan, I don't have enough facts on that. It is possible that there's no reassessment until both father and mother die. So just something to be mindful of. It depends on who originally owned the property. How will the cost basis be calculated as related to step up and spousal portability? You get a 1/2 step up in basis, or you get a partial step up in basis that is equal to your proportionate interest in the property. So you don't get a full step up in basis. So if you get 3 people on as joint tenants, 1 dies, a 1/3 adjusted cost basis in the property. But the full value of the joint tenancy property is included in a decedent's estate, but you only get a partial adjusted cost basis. If you're transferring property to a child in a trust or to an if you are transferring property to child in trust or to LLC, does child pay capital gains tax on the transfer now? I would say generally no. The only exception is if you make a distribution from an irrevocable trust in a year other than the year that the trust terminates, meaning if there are 2 properties in a trust and you distribute one in 2021 and you leave the other one in the trust until 2022, you're going to realize a gain when that property is distributed from the B trust, even though the property is not sold. So generally no, anonymous, but sometimes yes. What's a Prop 13 trust? A Prop 13 trust is an irrevocable trust that is used to effectuate a change in ownership from parent to child, but retains some benefits for the family, primarily getting an adjusted cost basis and creditor protection, asset protection. How does this affect our vacation home currently held in our trust? Your vacation home gets reassessed when you die, okay? This is when you die. There's no more parent-to-child reassessment exclusion. Brittany asks, my dad passed away in 2020. I am solely inheriting his Cupertino primary house. We will file for the change of deed between parent and child form on January 11th. Following the submission of those forms, can I immediately turn around and pass inherited property, the inherited home, to my child to keep the low Prop 13 tax rate through Prop 58, or do I need to wait for the deed to get recorded and confirmation from the BOE that my inherited house qualifies for the parent-to-child reassessment exclusion? Brittany, this is a tough one. Basically, the idea is, hey, Brittany's getting it from her parents, and then she wants to turn around and give it to her kid. maybe. Again, that is getting into the property tax realm. It is possible that would work. It is possible they view that as a step transaction. Something you need to understand is they do not, a step transaction is if you take all the transactions and mash them into one, they treat it as one transaction, not separate transactions. There's uncertainty in the law right now because when it comes to entities and family members, they currently do not apply the step transaction doctrine. But what you're talking about there, it may work, it may not work. It just depends on what county you're in, and you need to, that would take a little bit more thought and research on my part to make sure that it won't be viewed as a step transaction and mashed together. Steve asks, what is the most tax advantage structure to pass rental properties to children? Is there a way to keep property tax low and keep the step up? Yeah, Steve, that's the Prop 13 trust. Sometimes it's structured as a gift to the trust, and sometimes it's structured as a sale to the a sale in air quotes, because there's no realization of capital gains on that sale structure. Susan asked, trustee recently failed to pay current property taxes. Trustee recently failed to pay current property taxes. Death of surviving parent was 2019. House was transferred to her, the trustee, and 2 siblings. We plan to sell the house ASAP. Should we make sure the property taxes are current? Yeah, I mean, you got to pay your property taxes. And what's going to happen is if you don't pay them, all this stuff sees the light of day. You'll get a supplemental unsecured tax bill. And the question is, who pays that? Because it's not secured by the real property. It typically goes to an individual. You're going to want to find out and set aside some money to pay that tax bill. My mother passed away in 2019 and my father passed away in 2000. California rental property assets are held in a trust. Would we be able to get the $2 million exclusion in assessed value? It depends on, anonymous, it depends on how the trust is written. If your mother passed away in 2019, it sounds like it's not within 9 months to effectuate a disclaimer for your father, so that those properties would go to the kids. And I'm thinking out loud here. It may be too late, but you might still be able to get the $2 million exclusion. We just have to take a look at that one. And it also depends on how the trust is written. My daughter lives in a San Jose property I own. Is gifting the property the only way to preserve Prop 13? And if so, do I lose any control of the property outright? Anonymous, there's a way you can transfer the property to an irrevocable trust in exchange for a note. And so you get money back. So that's a possibility. And there's also a way to get an adjusted cost basis on that. So that's the Prop 13 trust. And Prop 13 trust is a descriptor. It's kind of like saying automobile. Well, trucks are automobiles, and cars are automobiles, and motorcycles are automobiles, right? So there's a lot of variance, but we're just calling it this Prop 13 trust. So we know what problem it solves. Christina asks, are you planning to give a presentation or have a Q&A? That's great. All right, I'll cut off the questions. Thank you, Christina. So let's go back to the presentation. Mom and dad died before February 16 of 2021. The kids inherit the house. The taxes stay at $1,500. They don't go up to $24,000, and the kids don't have to live in the property. If mom and dad die before February 16, if one kid wants to buy out the other 2 kids, there's a 2/3 reassessment. What this means is if the property's distributed to the kids, the 3 kids, and 2 kids want to buy out the other kid, 2/3 is reassessed. There's a way you can do that. Savvy lawyers, not just our firm, but many firms, know how to make sure that the trust or the probate process, in that process, one child can buy out the other 2 prior to distribution, no reassessment, before February 16, 2021, and the property taxes stay at $1,500 a year, and they don't go significantly higher. So this is buying out a sibling. This is a very important consideration for a lot of people. And the trust has to have a non-pro rata distribution power. Andy, one of the kids, this is dying February 16, 2021 and later, okay? The parent-to-child reassessment exclusion applies, but there's a limit. And so using this example of 1.2 million, if the tax base is 120, so we've got this tax base here of 120, and then $1 million reassessment exclusion applies, that brings you to 1.12 million. The remaining 880, which is 2 million minus the 1.12 million, is reassessed. And that adds $11,000 per year to the tax bill. So it goes from 1,500 to 12,500. That is the post Prop 19 world. And this is with great planning. In 2023, the $1 million exemption is indexed to the percentage change in the Federal Housing Authority House Price Index for California. And what's that? That's the amount that real estate goes up, or the federal government says the average in California goes up in any given year. So very, very important. Let's see here. I lost my mouse. There we go. So very, very important to understand this. Going forward, there are some limitations. If your home is assessed at $200,000 and the market value is $600,000, and you live there and you've got your homeowner's exemption, the $7,000 exemption on your tax bill, and your kids move in there, or your kid moves in there after you die, look, I mean, you're probably not going to be affected by Prop 19. But if your property's worth $2 million and your assessed value is $200,000, you have this problem. So if Andy buys out his siblings, Betty and Charlie, before distribution and does not live in the property, the property just gets reassessed. So the taxes go to $24,000 a year. So best case scenario, they go up 11. Worst case, they go up $24,000 a year. You got to understand Prop 19 guts Prop 13 protections for children. The parent-to-child transfer is eliminated. This is for residential, commercial, industrial, family, vacation, home, or cabin. This also applies to farms. There is a strategy that we can use that involves LLCs if you have more than $1 million in assessed value, right? So there are strategies out there that wealthier families have used for many, many years, and those are available after implementation of Prop 19. So what can a parent do? So what can mom and dad do now? Mom and dad, they can gift the property, this valuable property, right? This Prop 13 tax base to the children. The property is reassessed. Remember, the property is reassessed when there's a change in ownership. So number one, we have to trigger a change in ownership. Many transfers are not changes in ownership. If the parent says, I'm going to give my kid the house, but I'm going to retain the right to live in the house, there's no change in ownership until I die. If I say I'm going to give the property to my kids, but I'm going to retain the right to live here for 20 years. At the end of the 20 years, that's when the change in ownership occurs. So if I add my kids as joint tenants, that's not even a change in ownership. So it's very important that these rules are really quirky. They're archaic. Many lawyers just don't understand the ins and outs of the rules. So when there's a change in ownership, it's reassessed unless an exclusion from reassessment applies. So the parents, again, can transfer a home of any value before February 16th. And while they're alive, they can transfer $1 million each in assessed value to their children. But if there's one parent alive, then it's 1 million. But you got to do this before February 16th. So what can mom and dad do now? So what we're doing for a lot of clients, some clients do outright transfers. You know, if mom died and dad's 92 and dad's like, look, I'm going to assisted living. Here, take the cabin in Tahoe. I'm not even going up there anymore. I mean, I can see the case for potentially an outright transfer. It depends on the family. But so here's a Prop 13 trust solves a couple of problems though. A Prop 13 trust solves the problem of what if you give it to a kid and then the kid gets a divorce? Now you're battling with the ex-son-in-law or ex-daughter-in-law, and you don't want to deal with that. The other one is control. Some people don't want to relinquish control. Another one is some people need an income stream. So if you have a rental property that's in a Prop 13 trust, you might want to sell that property to the Prop 13 trust so you get a stream of income back. So there are a lot of reasons to do a trust. For many of our clients, one of the biggest reasons is the clients want an adjusted cost basis, especially on rental property. So when you pass away under current law, you get an adjusted cost basis. If you give your property to your kids and then you pass away, there's no adjusted cost basis, right? Because you've given it away. It's not in your estate. Now there's some exceptions to that, but many of our clients choose to use the trust vehicle because it protects the assets and then it has the ability to get an adjusted cost basis at death. It also lets you transfer the property to your kids and retain an income stream. Okay, so there's no one size fits all. This is far more dependent on a much broader set of facts. We have this video is up over 13,000 views now. It's crazy. Please subscribe to our YouTube page. We kind of took a pause in late December on doing webinars, but this is going to be a very busy tax year for everybody. Okay. And so it's very important that you subscribe to our YouTube channel so that you can stay current and this will pop up in your feed. So if you want to save Prop 13 for your children now, go to Cunningham Legal to set up a Zoom or phone consult. I prefer Zoom. A lot of this is visual. We're looking at documents. And then you got to collect all your recent property tax bills and locate your current estate planning documents. Get those to us before the meeting. I do review those before the meeting. Our consultation fee is $1,000. It runs about an hour, and then there is invariably follow-up. I had a question about this. I had a question about that. So that fee kind of covers that whole process of analyzing. And really, the purpose of a first meeting is to decide if there should be a second meeting. And a lot of people, they go, you know what? I don't need to do anything. Or, wow, this is a lot for me to digest, and I need to talk to my family. And yeah, I know we need to make some decisions soon. So that's the whole point of that meeting. And then obviously, if we're doing work, additional fees apply. Again, subscribe to our YouTube page. Now, there's a lot of good stuff in Prop 19. We have some prior videos. I would encourage you to go look at those videos on YouTube that do cover all the good stuff in Prop 19. But here's the other half of the big stuff happening in 2021. And I'm not saying this politically. I'm a realist. The Electoral College, the stuff, all this craziness is going on at the moment. But Joe Biden's going to be our president. It looks like the Democrats are going to have 50 seats in the Senate, and the Republicans are going to have 50 seats in the Senate. And Kamala Harris will cast the deciding vote. Many of the something very important to understand: many of Joe Biden's initiatives require 50 senators to vote yes, plus Kamala Harris if it's a tie. Many of his proposals do not require 60 votes. Now, that is because many of the things he wants to do are not lowering taxes, but they're raising taxes. So if it's revenue neutral or it's revenue positive, then you only need a simple majority in the Senate. And so here are kind of the big issues that we're looking at. Joe Biden is seeking to raise taxes on people with income above $400,000. And we're going to cover what the rates are. This is raising individual income taxes, capital gains, and payroll taxes, which is a biggie. If you're an employer and any of your employees earn more than $400,000 a year, or if you are a W-2 employee and earn more than $400,000 a year, under his plan, anything above $400,000 is going to be subject to payroll taxes. So you're going to get another 6% haircut. If you're an employee, if you're an employer, you're going to have to come up with your half of the payroll taxes. It raises taxes on corporations, and it raises taxes by $3.3 trillion over 10 years, reduces GDP by 1.26%, and it results in, for the 1%, 7.7% less income, and for everyone else, 1.9% reduction in income because of increased taxes. So here are the 10 Biden tax plans. Number one, higher minimum rate, not RAT, higher minimum rate of 37 to 39.6% on incomes above 400,000. There are no specifics on that. It's just, yep, we're going to raise taxes. Limiting the itemized deductions to 28%. And what this means is your deductions can't lower your federal income tax bill by more than 28 cents on the dollar, even if you're in the 39.6% maximum tax bracket. And also eliminating the $10,000 state and local tax cap. So what that is if you itemize your deductions and you pay local property taxes of $12,000 and you pay state income tax of $28,000, you're at $40,000. Under current law, you can only deduct $10,000 of that, but they want to reduce that so you could then deduct the full $40,000 from your federal return. And higher capital gains taxes. This is a doozy if it's over $1 million. This is just federal, guys, 43.4%. You can add 13.3 if you're a California resident or you have California source capital gains. Not pretty. So higher capital gains tax rates, higher Social Security taxes. So he's proposing this higher Social Security tax, not only the income tax, but a higher Social Security tax of 12.4% on incomes over $400,000. So if you are a sole proprietor and you have self-employment income of $500,000, you're looking at a $12,400 increase. If you have self-employed income of $1 million, you're looking at 6 times 12,000. So that's almost $100,000 in increased Social Security taxes. The biggie here is elimination of step-up in basis for inherited assets. This is the system that Canada has currently. where if you die, you do not get an adjusted cost basis. And let me tell you what that means. When Steve Jobs died, his widow inherited about $450 million in stock. Now, this stock had a low basis. Maybe it was Apple stock, maybe it was Disney stock, whatever it was, had a very low cost basis. So had Steve Jobs, while he was alive, sold the stock and realized a $450 million gain, it would have been about a $150 million tax bill. But after he died, those stocks got an adjusted cost basis, and his wife was able to sell those for $450 million and not pay tax. So this is a very valuable benefit. Many of our clients, if they are, a married couple, they've owned property for many, many years. It's fully depreciated real estate. When one spouse dies, let's say the husband dies, now the wife can sell those properties. Maybe they bought an apartment building for $50,000 that's worth $1 million. The wife can sell that property when the husband dies. If it's valued at $1 million when the husband dies, the wife can sell it for $1 million, tax-free, free of capital gains tax. So this is, when we rank these hierarchies of most powerful tax tools, I actually put this one at the top. I put this one at the top, certainly for married people, because when one spouse dies, the other can sell property tax-free. You get an adjusted cost basis. If you don't sell it, you can start redepreciating the property. And I was on the phone with another attorney this morning who said, I was talking to this attorney and they don't do valuations for their clients. When a spouse dies, they don't tell their client to get an appraisal, a real appraisal from a certified appraiser. I think that's a big mistake because this is a huge benefit. And why wouldn't you? In this case where the husband died and the wife has $1 million property that she's going to keep, she can start redepreciating that property, over a 30-year period. Why wouldn't you get an appraisal? It's going to pay for itself in the first year. So elimination of step up in basis, really big deal. This is another one, elimination of real estate tax breaks and elimination of the 1031 like-kind exchange. A 1031 like-kind exchange, husband and wife they paid $50,000 for the apartment building. Now it's worth $1 million. No one's died. So husband and wife, they say, I'm tired of leaky faucets and plugged up toilets and dealing with this. Let's sell it and let's buy a different property. Okay. Maybe we'll buy a property that's a ground lease and there's a Chick-fil-A on it or something, whatever. So they can sell that property, the pain in the neck property, and they can delay payment of capital gain and put that in a new property. And then when the husband dies, the wife has an adjusted cost basis and she can sell that tax-free, right? But that 1031 exchange where you sell one property and buy another property, that is potentially going away under the Biden tax plan. So, for a lot of people, that's how they've created a lot of wealth, is buying and selling property, right? Maybe you buy a property and fix it up and then you flip it and you do a 1031 exchange into another one. That is proposed to be eliminated. The increase in the child and dependent care credits, doubling, that's good. It's basically free money, right? So it's a pro-family, and this is regardless of how much you earn. If you don't earn any money, you get a credit, you get a check in the mail. And then a $15,000 tax credit for first-time home buyers, and that is obtained when you buy a home. So that's a good benefit. So to help people get in homes, the big one is the green energy. And for those of you who buy oil and gas credits or oil and gas investments, those are tax favored. It's one reason why the U.S. is the #1 oil producer. Biden's plan is to promote green energy. And so I think what you'll see is an increased or an expansion of the electric vehicle, solar, those types of green energy initiatives. There's actually a very powerful tax planning tool out there, which is where taxpayers can make an investment into either a fund or directly into a project. And you can basically buy a solar project and you get some tax credits. So it's a lot like, if you buy a Tesla, you get a tax credit. A lot of these is a solar operation going in at a church or going in at a school or going in a nonprofit. Well, they can't really benefit from the tax credit because they're tax exempt entities. And so they effectively sell off those tax credits to investors. And that's a whole world out there. And basically you put in $1 and you get about $1.50 in tax benefit. So if you otherwise would owe $150,000 in federal taxes, if you put $100,000 into the program, it covers your $150,000 tax bill. I think we're going to see a lot more of those under with Biden. So tax rates may go up, but then all these other tax planning strategies also go up too. You know, basically it's an expansion of government, and the government's wanting to direct people how the money's invested. I think on a high level, that's kind of the overall plan. You can agree with that, you can disagree with that, but I think we can agree that's really what's going on. And finally, of course, repeal of the Tax Cuts and Jobs Act. Now, this is really big. This is really big for a lot of taxpayers. It gives you the 199A deduction, which is a 20% deduction for business owners, except if you're a lawyer or an accountant. But Biden wants to repeal this, is the bottom line. And so this put in the flat corporate tax rate at 21%. We're expecting the tax rate to go to 28, if we had to guess. And then a 15% minimum tax on corporations with at least 100 million in income, who basically pay little federal tax under the regular rules. It's almost like an AMT, an alternative minimum tax for corporations. So you can agree with that. You can disagree with that. I'm the messenger. I'm just telling you what we're anticipating. So what I would think is, I personally think the change is going to be effective in 2022. And the reason is, we're in the middle of a pandemic still. A lot of people are hurting. I think the government's going to be spending a lot of money now. They want to keep people employed. I can see 2022, the vaccine's out. The economy's coming back up. I'm anticipating a robust economy. I talked to a lot of business owners. I talked to a lot of people with money, and they can't wait to get out and start spending it. Go on a vacation. Go do all these fun things. Go out to dinner again, right? Go out to lunch. Go to the movies. I really see a booming economy once we can get the vaccine widely spread. But something to pay attention to: the income tax increases. I see an across-the-board increase to 39.6%, and that's probably on incomes over 400,000. California also has a proposed 3% increase to its state income tax to go from 13.3 to 16.3%. I could see that happening too. The gift tax rate increased from 40 to 45%. Again, elimination of step up in basis on death. Now, the capital gains, if you're in California, you have great weather, but you pay a lot more tax. And so the increase in the capital gains is from 20 to 39% federally. But remember, there's a 3.8% net investment income tax and a 13.3% income tax. So our effective rate for Californians for capital gains is 37.1%. Now, this is on a high dollar amount, but if you sell the $2 million property with a $500,000 cost basis, you're going to be paying these marginal rates. Okay, so this is a big deal. It's especially a big deal if the 1031 is eliminated and you need to sell the property for whatever reason. With Biden, those three, the 3.8, that increases. It goes to 56.7%, whatever it is. It's over 50% on capital gains taxes. So for a lot of people, that is going to make people not want to sell property. I mean, they already don't want to sell it with and pay the capital gains tax rates as they are now. But going forward, I can really see people being reticent to selling the property, right? Especially if your tax rate's over 50%. Now, what about the death tax rate? So the death tax rate is at 40%, and let me clear that there. So what about death taxes? And that's what a lot of people are thinking about. When I started practicing law, you could leave $600,000 tax-free. Everything above that was taxed at up to 55%. And if you skipped a generation, it was even higher. So death taxes are at an all-time low. And what I mean by that is you can leave $11,700,000 each, if you're married, each person. So that's $23.4 million tax-free to whoever you want. Now, you can do that in a trust. You can do that in a partnership. There are a lot of different strategies you can use. Guess what? You can still keep control of everything, which is really cool. Because if you can give ownership, but you keep control and your lifestyle doesn't change, why wouldn't people do that? And really, frankly, it's kind of a no-brainer, because when you pass away, those taxes are going to have to be paid. Now, you might be saying, well, Jim, 11.7 million, that's the Rockefellers or Gettys or whatever. That's not me. Just wait, because the rate is going up. This is the Biden plan. 67.3% estate tax rate. And I'm going to show you how the breakdown works on this. But bear in mind, this is going to start affecting people once you hit $3.5 million. So it's very important that if you have a $2 million estate and you're 60, you're probably going to have a $3.5 million estate when you die, right? Your assets are going to keep going up. And it is possible that your estate could now be subject to paying death taxes. So this is a breakdown. This is from the Tax Foundation. Now, this is a $100 million estate, but I'm showing you this because the math is easy to understand. Here's the Biden plan. The Biden plan is if you have an estate, just say it's a $100 estate, your capital gains tax, we're going to charge you capital gains taxes on that. Now, I don't know if it's just on the gain. I don't know if it's on the whole thing. We don't know. This is just I'm going to raise taxes. And we're trying to figure out what all that means. So you're going to owe on $100, you're going to owe $43 in capital gains tax, right? That's kind of a lot of money. And then what's left over, you get to exempt $3.5 million. And then that leaves you with, in this case, $53 million. And your tax rate is 45%. Your tax rate's 45% here. And so your taxes are 23 cents on the dollar. So your effective tax rate, when you add all that stuff up together, your effective tax rate is 67%. And if you have a $5 million estate, you know, is it going to be this high of a tax? No, it'll be, 45%. Let's see, 60 on a million. If you have a $5 million estate and $1.5 million is taxable, yeah, you might end up with an $800,000 tax bill, right? So this is real, and this is not going away because we have Democrats in the, we have a Democratic plurality, I guess the majority if you can't count Kamala Harris in there. But the Democrats are, the Democrats are essentially in control of the Senate here. So, and I'm having a slight technical issue here. There we go. So when can we expect these changes? As I said, I think these are going to be effective 2022. And here's the really big reason. You can't start monkeying around with W-2 withholdings. It's just improbable. Number one, I don't think it's likely we're going to get a massive tax hike during a pandemic, and this thing's going to be around with us for the remainder of this year at least. But I will say 2022, I think I can see it. So there are a lot of it makes it really difficult to retroactively raise taxes. Now, cutting taxes is easy. Everyone goes, yay, I get more money back. But raising taxes is effectively, the regulations have to be rewritten. This is a massive ship. Our country is this massive ship, and you can't just turn on a dime. You've got to kind of slowly move the ship. So I will just say that there are well-established strategies that have been around for a very long time that right now people who are over 10 million in wealth are using, or over 20 million in wealth are using, and many of those people are our clients. Now it's going to go back down to 3.5 million or 2 million. So if you got a $5 million estate, and a lot of people have a $5 million estate, you need to start thinking about estate taxes again. Death taxes. You need to start thinking about this because look at that 67% rate. In the early 70s, the marginal rate for federal estate taxes was 77%. The stated reason, if you open up the Internal Revenue Code and go to the estate tax section, the purpose of the estate tax is to redistribute wealth. That's the purpose. Now, I don't know if it was a coincidence that it was passed right around the time of the communist revolution in Russia. Maybe, maybe not. I don't know. But my point is, the reason it's there is to redistribute the wealth. It's to take it away from wealthy people and redistribute it to the people of the United States. That's why it's there. And if you think that the Democratic initiative is not about redistributing wealth, and I say that in an apolitical sense. So if you're a Democrat, please don't be offended. And if you're a Republican, you're probably not going to be offended. But we have a serious equality problem in our country, right? On a lot of different levels, and it's not getting better. It's getting worse now. And this is a mechanism by which wealth can be redistributed. So that's the point. And that's why I think we're going to end up with higher death taxes. We're going to end up with higher income taxes. If you have not heard of modern monetary theory, you really need to read up on it. So Google modern monetary theory, also known as magic money tree, Basically, modern monetary theory says this: the federal government can print an unlimited amount of money, and so long as the government taxes the people enough to pull the froth out of the economy, we can print as much money as we want, and we will not have an inflation problem. Now, you can agree with that, you can disagree with that, but that is Janet Yellen, that's our new Treasury Secretary, that's AOC, that's Biden. They all subscribe to modern monetary theory, so you need to pay attention to it. All right, so who should do what and when? I think if you have more than 2 million in assets, you need to start talking to a lawyer about death tax planning. So if you have 2 million, 2 million is not a big number. I mean, 2 million is a lot of money, but 2 million is not a big number. Many people have a home that's worth 2 million that they bought in Fremont, in 1976. So there's a lot of people out there who have a larger estate. And I think we need to really be mindful about death taxes going forward. So what do you do now? And then I'll go through and answer these questions. What do you do now? Go to Cunningham Legal, collect your assets, and we can do a real thorough analysis of whether you should be doing some advanced planning or not. Now, this fee is $1,000. It's the prep, the meeting, the follow-up. We typically have charged a lot more for this in the past, but we need to bring it down. We're having a structure in place so that really beginning in March, because we're very busy with Prop 19 right now, beginning in March, we're going to be having these meetings with our clients, because in 2026, the current law expires. So January 1 of 2026, this is really important. You need to please pay attention to this. January 1 of 2026, the current law expires. A gift that is made within 3 years of death, any transfer that's made within 3 years of death comes back into your estate. So January 1 of 2026, so the law expires December 31 of 2025. Well, 25, 24, 23, that means January 1 of 2023, even if Biden doesn't get his tax plan through, gifts made January 21 of 2023 and later, if you pass away in 2026 or later, they can come back into your estate with a lower exemption. So that means you need to think about getting your planning done in 2022. Well, what's the problem with that? The laws may change, right? I think Biden's laws are going to be effective 2022. I'm just making that call right now. That means you've got 2021 to do all this stuff, all right? So really pay attention to it. Please don't let this get by. If you're concerned about death taxes, please reach out to us and set up a time and we can talk. So I'm going to go through some questions. The remainder of this will be Q&A. For those of you who would like to reach out to us, there's our information there, CunninghamLegal.com. Like us on YouTube, or subscribe on YouTube. Stay in the loop on all this stuff. But Kirsten asks, are there any legal entities, trust mechanisms that we can transfer properties to now before February and will allow properties to be transferred at death to children without a reassessment? Yes, Kirsten, that is the Prop 13 trust. And that's the mechanism. It's an irrevocable gifting trust that does not contain certain powers that cause problems and contains other powers that are beneficial. It is a new kind of trust, okay, built on an existing platform, for lack of a better term. And so very few lawyers, our firm's one of them, that have really figured it out. But I would recommend looking at a Prop 13 trust. Teresa asks, does trust terminate when the grantors pass away, and does property get distributed to the beneficiaries? And is this considered transfer of ownership when this happens? Teresa, when the trust is created and the property is put into the trust, that is when the change in ownership occurs. And this is an irrevocable trust. This is not a living trust. Do not do this on your own. You're going to screw it up, okay? You need professional help. But to answer your question, Teresa, the property passed when the property went into the irrevocable gifting trust, so that when the parents pass away and it's later distributed, you have to clearly communicate to the assessor that, hey guys, the change in ownership was prior, and there's a method to do that using the forms. Brian is asking, under Prop 19, the parent-to-child exclusion from reassessment remains in effect if the property is declared the child's principal residence within a year. Yes. Question, how is the term principal residence likely to be defined? For a large acreage rural residence, would a detached garage, guest home, storage building, equipment building, pool, spa be included in what is considered a principal residence in addition to the main dwelling? I view principal residence as checking, from what I've seen in the statute, you have to check the homeowner's exemption. If you're on a large piece of property, it is possible you have more than one parcel. It is possible those other parcels might get reassessed. Just something to think about. So really pay attention to this. Unfortunately, we don't have the answer. The legislature hasn't made the rules yet. Does the Prop 13 trust protect step up in basis and Prop 13 taxes? Teresa asks. Yes, that's the idea of it. It kind of threads the needle on property taxes, capital gains taxes, and death taxes or estate taxes. It threads that needle and accomplishes multiple purposes. This is a very well thought out strategy. I personally spent about a month on this after the election. And then I've been working closely with very intelligent attorneys all over the state of California. And collectively, we have come up with a structure that works. So, and then Anonymous asks, in 2015, me and my two sisters inherited our parents' home. That in 2015, we applied for Prop 58 to preserve my parents' property tax base. 1 year later, I bought out my two sisters and the property was reassessed at market value for property taxes. Is there anything I can do now to recover my parents' original property tax or reduce my current assessment due? You should have only been reassessed on 2/3 of the property, but if you were reassessed, it depends on when you're reassessed because there's a cutoff on your appeals process, and it depends on the county that you're in. It's possible you could get some discount, but based on those facts, probably unlikely. Again, not legal advice. Don't rely on that. But we could certainly help you with that, or get you to somebody who can help you with that. And the reason is we're a lawyer, we're a law firm, we do lawyerly things. There's another subspecialty, which is strictly reassessment issues. That is typically done sometimes by lawyers, frequently by non-lawyers. These are former employees of the various assessors in the various counties. So there are companies out there that do that. Now, they don't do the legal work like the trust work that we're doing. They don't necessarily do deeds, but they certainly go through the real property tax issues, and that might be of help. Thanks. Would that Prop 13 trust be affected by Prop 19 then? If the Prop 13 trust is irrevocable and funded before February 16th, it's not affected by Prop 19 because Prop 19 takes effect February 16th. Is there a concern with creating a Prop 13 trust when there may be changes to Prop 13 on the horizon? Yeah. So there's been a fair amount of chatter out there, if you will. I heard the Howard Jarvis Taxpayers Association is trying to get an initiative together to bring back the parent-to-child reassessment exclusion. Who knows? I don't know. I can only go on what the law is. And I will tell you, for some of these people, these numbers are significant where, it's a multi-million-dollar property with maybe a $200,000 assessment. So these are big numbers, and to wait on a change in the law, I'm not sure that's a good plan. Jeanette asks, I'm a realtor in LA County and I have many clients that need guidance. Can I meet with someone for a consultation to go over some general scenarios to see which clients need to hire your firm? Yes, the consultation, there it is right there. You book a 1-hour consult and we can go through, and if you're a lawyer watching this, we're happy to go through these issues with you. We co-counsel with a lot of other law firms. Are there any legal mechanisms available to which we can transfer rental properties now, keeping the property with the parent, that will allow the properties to transfer to the kids at death without a reassessment? Well, what you do, Kirsten, is that's the Prop 13 trust. You can do a gift to the trust or you can do a sale to the trust. The difference is if you do a sale, you get an income stream back. And then the next question is, do you want that included in your estate or not? If it's included in your estate, your kids get an adjusted cost basis. If it's not included, you don't get an adjusted cost basis, but it's not included in your estate. So if we end up with a Biden $3.5 million exemption, that may be really important. These trusts, by the way, the default is set up to be a completed gift in most instances that stays out of your estate. It's a lot easier to bring it into your estate than it is to bring it in and take it out. Okay. So that's just a little technical point. Teresa asks, does the trust terminate when the grantors pass away and does the property get distributed? I think we already answered that one. Does a Prop 13 trust protect step up in basis? Yes, if that's if you want to step up in basis. Anonymous asks, if an outright gift is not possible due to an existing mortgage and insurance issues, would a 50% tenant in common transfer to a child now and the remaining 50% to pass to the child at death through a revocable trust prevent reassessment if the fair market value of the half passed through the current trust is less than the base value, $1 million? Under current law, would the step up basis only be available on half that is passed through to the trust? Well, this is interesting. I don't know if this is a house or not. It didn't say if it's a residence or a rental. If it's a residence, not quite sure if that $1 million is $1 million of assessed value, or if it's proportional to the interest that's passed. But certainly if you transfer your property to your kid as a tenant in common, 50%, that is a parent-to-child transfer. If they inherit the other 50%, after Prop 19 becomes effective February 16th, that other 50% is subject to reassessment. Unless it's a home, you claim your homeowner's exemption and your kid claims the homeowner's exemption within a year. Kind of complicated. There is also potentially under those facts, potentially solving the issue using an LLC with at least one other individual in the mix. You wrote our trust oh, hey, Kevin, you wrote our trust 2 years ago. Is the consulting fee the same? Yes. Right now it is. We are extremely limited on our bandwidth. And frankly, we have a lot of people who paid us a lot of money to get work done. We still need to get that work done. But yeah, that is the fee. Would that be different after February? Not sure. Well, for Prop 19, I'm not even sure it'll be relevant after February 16th. Although we are having another webinar. If you miss the whole Prop 13 gold rush to get your assets, your properties to your kids, there is another way, right? It's kind of like Yoda in Star Wars. There's another way. There's another way to do it. It's more expensive. It's more cumbersome. It's a bigger pain in the neck. It's using entities, right? And that's frankly what rich people do. If my husband died, will the step up still be valid if the new law eliminates step up in basis if I sell in the future? Anonymous, the basis, the stripping of the adjusted basis is going to likely be prospective. So if your husband passed away a couple of years ago and you got an adjusted cost basis, I don't think that's going to be taken away from you, but I don't know. It could be, but I doubt it. Do I need to divide the 2019 tax return into 2 parts for my rental house by using one of the old rental house depreciation? Since my wife passed away in mid-year 2019, the step up is, so you're going to file, sorry, I went through that quickly. The question is, wife passed away and husband is asking, how do I deal with my 2019 tax return for the rental house? Do you use the old depreciation or the new depreciation? Talk to your accountant. You get an adjusted cost basis in the year of death. You will be filing a widow's or a widower's tax return. I don't know if you get your new basis for depreciation this year or 2019 or 2020. You just talk to your tax preparer. How about SALT tax relief? Yeah, that's Biden wants to, that's definitely a blue state benefit. So blue states voted for Biden and they want to bring back the SALT deduction, which allows us, if you pay $100,000 in state income tax in California, you can only deduct 10 off your federal return. You're going to be able to deduct that full 100,000 if the SALT limitations are eliminated. With the new Biden elimination of step up in basis on death, does the Prop 13 trust protect against this? No, because the Prop 13 trust, when we get a state inclusion, it's included on the death of the individual. So it's whatever the applicable laws are when that individual passes away. And that's why it's important to really look at these trusts and add these levers that cause inclusion rather than put them in there from the get-go, because you may not want inclusion. And if you think about it, if you're 70 and you put $1 million property in there for a kid and you die at age 100, that $1 million property could be worth $5 million. You might not want inclusion on that because you have to pay taxes on it. So, so something to think about. For the lifetime gift exemption, is the $3 million per person or in total for 2? Don't know. It's because they say $3.5 million exemption, and he gets a yeah. I want to raise taxes. I don't know. I suspect it's per person, so I suspect couples would get 7 million. I have not heard anything about eliminating portability, and this is very important. If you lose a spouse, it is very important for you to consider filing a federal estate tax return because you inherit your spouse's exemption. Now, if you had a spouse die in 2020, that exemption is 11.58 million. I think you might want an extra 11.58 million, especially if you end up with a $3.5 million Biden exemption, because if you don't capture that portability, if you don't keep it, right? If you don't claim it, you lose it. So you're limited to a $3.5 million exemption. If you die with a $5 million estate, you're looking at $800,000 tax bill, right? So it makes sense to hire good advisors and seek their advice and take it, right? So that would be if a spouse passed away, you definitely want to consider filing a portability return. What's the ballpark figure of doing a trust after the initial consultation? We have a video on how much should a living trust cost on our YouTube page. I would encourage you to look at that. Regarding estate tax, are stocks with transfer POD beneficiary considered part of the estate for tax purposes? Yes. Life insurance, IRAs, POD, TOD, jointly held accounts, all includable in your gross estate. And if you have 10 million in stocks with a POD, you might want to rethink that. You'd certainly give us a call. You might want to do some advanced planning on that one. That's not a POD or a TOD. Roberto asks, when having the consultation, should the parents, 91, and the kids be present, or could the kids just be there to decide whether or not to move forward? That's up to you. Sometimes the parents are there, sometimes they're not. I've had parents get up and walk out in the middle of a meeting over over video. I'm not sure they get it, but I'll just leave that up to you. Are there transfer taxes to be paid at the time a Prop 13 trust is created? Well, there is. If it's a donative transfer, if it's a gift, there's no documentary transfer tax. If there's a sale, there's a 0.1% documentary transfer tax. So that's $1,000 per million. Just something to be mindful of. And then how does Prop 19 property tax portability work if I'm a senior and buy a replacement property together with my child? Do I only receive transfer of my tax basis on my proportional interest of the property? Yeah, on that one, what Anonymous is asking is the good stuff in Prop 19. There's some other videos on our YouTube page on that. The good stuff in Prop 19 is you can sell a property and transfer your Prop 13 tax base 3 times in your life if you're over 55 anywhere in California. So let me say that again. I have, my wife dies, I've got $1 million home and my assessed value is 100,000. I now have an adjusted cost basis. I can sell that home for $1 million, put the cash in my pocket, go find another home, maybe in a different part of the state, buy that home for $1 million, and I take my low $100,000 tax base. So my taxes, instead of being $10,000 a year, they're $1,000 a year. In that case, Anonymous, you might want to think about the parent buying the property and transferring the tax base and then making a gift to the children if the child's going to live there. So something to think about. These are great questions. We're waiting on the legislature to kind of color in the lines on this one. Alma asks, why is it important that Prop 13 trust income pass to parent during lifetime? Well, that may be from the grantor trust. So a grantor trust is a trust where the IRS disregards the trust and they treat the grantor, the parent in this case, as the owner of the property. So if I have a rental property and I put it in a Prop 13 trust, that's a grantor trust. I still get the depreciation. It's pretty cool. I don't get the income. I actually can get stuck paying the tax bill and I don't get the income. But the advantage of that is I'm further depleting my estate and it's an effective wealth transfer to my kids. So I hope that answered your question. Anonymous asks, will the $500,000 exemption on the sale of your residence in California remain in place? I don't know. I haven't heard anyone taking, that's the Internal Revenue Code Section 121 exemption. I have not heard them poking the bear on that one. Just haven't heard about it. What does it mean that the Prop 13 trust is an irrevocable living trust? A Prop 13 trust is an irrevocable trust. A living trust is a revocable living trust. A revocable living trust, you can amend it, you can change it, you can revoke it. It's your alter ego. It's as if it were you. That's a living trust, a revocable trust. An irrevocable trust is where you can't amend the trust. You put that property into the trust, it's a gift to your children. The assessor says, you've done one of these gifting trusts. Parent has transferred the property to the trust. The child is the beneficiary. Now the child, that's triggered a change in ownership. You file your Prop 58 form before February 16th. All is good, right? There's been a change in ownership, but an exclusion applied, so there's no reassessment. You can't do that with a living trust because if you have the power to take, in a living trust, you have the power to revoke the gift. That's not going to be deemed a completed transfer. You won't get that parent-to-child exclusion. That transfer is deemed to occur at death. Can you add an irrevocable trust within the current living grantor's trust? Not really, they're separate documents. If the property is sold within the next couple of years, will a gift trust added to the original platform keywords to open? So if the property is sold within a few years following death, I wouldn't do any I'm not sure it makes sense to do Prop 13 planning. Prop 13 planning, it makes sense if the kids are going to hold this property for a really long time. Okay. If it makes sense, if you're going to hold it for a long period of time, if you're not, it doesn't really make sense. If you put rentals into the irrevocable trust and you were depending on that income, what happens to the income from the rentals? Well, Teresa, that would be a situation where we do a sale to an irrevocable trust so you can get the income stream back. I was late. Will the recording be available? Yes, it'll be on our YouTube page in a few hours, I believe. Alan asks, will the Prop 13 irrevocable trust protect from the potential elimination of the step up in basis? No. Do you think SALT taxes will be eliminated under Biden? I think his tax plan, if he here's what happens. You know, in the 50s and 60s and 70s, I think the highest tax rates were like 98% or something. I mean, everyone forgets this. But your tax rate might have been crazy high, but you had all these weird, crazy exemptions. Like you could buy a property for $1 million and say, well, I'm really buying this property for $50,000 and I'm front loading all of the interest, $950,000. And so I get an income tax deduction for that $950,000. So yeah, the rates were higher, but people didn't really pay. I mean, some people did. But you know, there were a lot of other tax goodies and there are a lot of other deductions that were taken away, frankly, under Reagan with the 86 Tax Act. Gina says, I called a few days ago to set up an appointment. I've not heard back. Any ideas on the timeline to get an appointment? Gina, I would call again. And if you can call during business hours, you're more likely to get somebody. Arlene says, would death taxes be assessed on Roth accounts? Yep. Roth accounts are included in your estate, not subject to income tax, subject to death tax. Absolutely. If I buy a consultation, can I email you my draft of AB Trust, which is including most of the information? Sure, please do. Anonymous asks, parents have 3 rental properties and 1 primary residence, mortgage free. What are the recommended actions to limit taxes for son? What issues need to be addressed to determine the best course of action? Well, Anonymous, I say on that one, I would ask your son, are you gonna keep these properties long-term? Are you interested in keeping these properties long-term? We also look at your estate. Do you have a taxable estate? Are your assets over 5 million, right? 3 million? Yeah, probably. Well, maybe we should do these gifts. We should consider doing these gifts as an irrevocable gift and not included in your estate, perhaps. And then maybe if you want to do a sale so you can get some rent income back on one of the rentals, that's what we talk about at the meeting. And actually what we do is I put them on an Excel spreadsheet, each property, the cost basis, the assessed value, the market value, what the taxes would be if it got reassessed. And we kind of walk through that. We use that as a guideline to walk through with clients so that you can get a visual and kind of get the flavor on this. And I got to tell you, the fact that you have to make these really important decisions in such a small, short period of time, it's nuts. I mean, if this thing was delayed till December, that would be the right thing to do so people wouldn't have to make these decisions. I don't think that's going to happen. We can only hope. Kathy says, I'm single. I have no children. Will you be having a meeting about that? I have 3 nieces. Yeah, Kathy, the strategy you may want to use if you have 3 nieces, and this is a great strategy, please call us, set up a time. We can do that after February 15th because you can use an LLC strategy. And the LLC strategy is very effective when it is a transfer not from parents to children, under our current structure, but pretty much everyone's going to be looking at this after February 16th. So there is a way, you don't have to hit the panic button, but I will tell you from a practical sense, it's much easier. There's less care and feeding of the plan if you can do this before February 16th. Does an irrevocable trust allow for a 1031 exchange in the future if it's a triplex? Sure. It can be written in a way where it is neutral on your ability to do a 1031. With the Prop 13 trust, can all the siblings be added or should it be just one? What happens when just one wants the property? That's something we should pick up in the meeting. It's going to complicate things if you try and buy out a sibling. Anonymous asks, Prop 13 irrevocable trust with real property to child prior to 215 with parent-to-child avoidance of property reassessment. What is the mechanism in the trust that still allows a step up in basis post 215? So there are a couple of approaches on this. So the question is, Jim, how are you doing that? What's the secret sauce? What are you doing? Well, there's Internal Revenue Code section 2038. And 2038 says, if the grantor, the parent, has the power to defer payment of income and principal and exercises that power to maybe delay the receipt of income and principal by maybe a year, maybe 6 months following the grantor's death, That power brings the property back into the grantor's estate. Now, what we're doing is we're having a trust protector, which is a person who has control, which is a person who has control over the trust, but is not the trustee. A trust protector has the power to grant this authority to the parent, the grantor. Then the parent has to exercise it. That gets you inclusion. And under 252511-2D, which is a tax regs, it says the mere delaying of the distribution does not make the underlying gift incomplete. And what that means is you still file your gift tax return. So you transfer that $1 million property, you use up your estate exemption, and then you have a choice whether you want that property included or not. Okay. So if it goes up to 3 million and you go, wow, Biden dropped the raised estate taxes, and I don't want this included in my estate because my kids are going to have to pay 67% death tax. You would not want that power. So that's why we're making these, most of them, complete from the beginning. And then there's this power to pull the levers to get estate inclusion. So that's how we're doing it. Brittany asks, if I inherit my dad's house, filing the paperwork in January 2020, can I then immediately create a Prop 13 trust to beat the February 15th deadline? Trying to keep your low property tax for your child. Yeah, I mean, I think that's something we should talk about. And you might be able to do something else. It depends on when you inherited your dad's house. You might actually be able to disclaim it, where you say, no, I don't want it. But that being said, you were deemed to have predeceased. So the other parent would have to be deceased. I'm just thinking out loud here. But I think that's something we should talk about. Yes, I think there's a solution. Go ahead and set up a time to talk. Jeanette asks, my sister-in-law's mother just passed December 16, 2020, but still has not been buried. So my sister-in-law has not seen her mom's trust, but assuming the mother left the property that was paid off to her 3 children, they will sell the home if there's something they should know, just in case one of them decides to keep the property. Yeah, so death is a change in ownership. The one thing I don't know is if you try and buy out a sibling, can you still do that after February 16th of 2021? I don't know. I would have them get on it and pay attention to it. But if they're going to sell the property anyway, right, they're going to sell it. There's no reason to do any kind of planning to save Prop 13. If a child predeceases the parent, this is a good one. If a child predeceases the parent after a Prop 13 trust is created, what happens to the property? Well, it depends on who gets it. If the child's spouse gets it, it's not a change in ownership, no reassessment. If it comes back to the parent, guess what? It's reassessed. So what we're doing for a lot of clients is we are taking, if more than one person receives the property, we're putting that property into an LLC. Because if 2 people have a 50-50 ownership interest in an LLC, and one of them dies, and that 50% ownership interest goes to somebody else, not the other person owns the 50%, there's no reassessment. And that's a very powerful tool. So what I mean by that is if you put the property in an LLC, 2 people, and one person dies and they leave those LLC shares to somebody else, there's no reassessment. Now, after that, you need to take the property out of the LLC and then put it into another one. But that is a way of gaming the system. And we're going to see a lot more of that after February 16th. If a parent misses the February 15th deadline for the Prop 13 trust, can we do the LLC route after February 15th? Yes. Can Prop 13, well, maybe, perhaps, but you need more people. It really doesn't work with one person. I mean, it can, it's more complicated. But some of these numbers, frankly, are astronomical. We're working on a case now where the assessment is way in excess of $10 million and the property's worth $100 million. I mean, sometimes the numbers just get astronomical, okay? Can the Prop 13 trust be revised later if the California legislature interprets sections of the law contrary to the current BOE policy, renders the transfer of the trust an invalid change in ownership based on some trust term? Yeah, I mean, there's a mechanism, a trust protector. I think these are written in a way to trigger, specifically to trigger the change in ownership under Revenue and Taxation Code Section 60. There's a 3-pronged test. These trusts are written to do that. And by the way, we've been doing that for a long time. So this is nothing new. What's not new is giving the property to a kid. Okay, here you go. What's not new is, oh, we're going to put this in a trust. And now the kid's the owner and the parent's not taking anything back. What's new is, hey, I'm the parent. I want to give this property to the kid, but I want it included in my estate so I get an adjusted cost basis. Now that is a new wrinkle, because nobody would have ever done that before. And that's part of this sort of rewiring of the lawyer's brains. A lot of what we're doing, if you talk to attorneys out of state, they're going to go, that's like the stupidest thing I've ever seen. Why would you give away a property that comes back into your estate? Well, the reason you want to do that is you want to trigger the parent-to-child transfer so the kid doesn't get reassessed when mom dies. So remember, there are 3 taxes we're talking about. The property tax, that's the annual tax you pay every year. Capital gains tax, frankly, not as much of an issue if it's not rental property that you're depreciating. If it's a family vacation home, you're not going to sell it anyway. What do you really care? And then the third one, of course, is the death tax or the estate tax. Is it best to know if our kids want to keep one or all of our properties prior to a consultation, or will you have time to give us all options? Anonymous, I would say, so here's your homework for the people a lot of people still on here. Ask your kids, hey, we have 10 properties. Do you want any of these? They might go, yeah, we want 1 and 4, but the rest we don't want. Have that conversation first. It's going to narrow the scope of what we talk about. But it's funny because for the clients who have multiple properties, many times we start talking, they go, well, maybe we do want to keep all the properties because Prop 13 is a really good deal. So, but I would check in with your kids. It's a good idea before the meeting. Nellie asks, is a Prop 13 trust an intentionally defective grantor trust? Typically it is, yes. Anonymous asks, the son rents out one of our rental properties. Son plans to keep our primary residence as a vacation home and remain in the rental home. Do we have to move in the rental home and claim the homeowner's tax exemption for the son to realize the parent-to-child tax benefit after our death? After February 16 of 2021, yeah, that's going to be in play. If you do something now, it doesn't matter because you have a parent-to-child reassessment exclusion. So I would suggest you give us a call and we talk about it. Is there any reason I cannot get a Prop 13 trust before? Oh, if by any reason I cannot get a Prop 13 trust done before February 16, can I still do an LLC trust? Yes, you can still do these transfers by LLC. I'm just giving you a warning. It is a not as direct a path for most people. It's a more circuitous path. It is not point A to point B. It's point A to point C to point D to point F, back to point B, if that makes sense. So it's a lot more, frankly, a lot more work and kind of a pain in the neck, but it works. Can we protect our Prop 13 rental properties not in an LLC can we protect for Prop 13 rental properties not in an LLC by creating one now before February? Creating an LLC before February is not really getting you anywhere. You got to do Prop 13, how we've been talking about with the Prop 13 trust. You need to do the trust. You need to transfer the properties before February 16th. It's a lot harder than you might think. It is not that far away. We have 2 questions in the chat. What are the fees for a Prop 13 trust? We can talk about that. It's not cheap. Jerry asks, will we be able to view or listen to this webinar in any way? Yes, it'll be recorded. And that recording should go up I'm not quite sure when, but we're recording it and it will go up as soon as we get that done. So with that, I will conclude it. And it was a pleasure to share this time with you today and talk about Prop 13. Please go ahead and subscribe to our YouTube page, and we look forward to meeting with you soon.